Welcome to Outside Views. Today we're diving into a topic that reveals the economic consequences of Brexit in a way that is impossible to ignore. The staggering outflows from UK equity funds since the 2016 referendum. Nearly £100 billion has been withdrawn from UK-focused investment funds, a direct reflection of investor confidence in post-Brexit Britain. This exodus raises critical questions about London's position as a global financial hub, the ability of the UK market to attract capital, and what can realistically be done to stem the tide. To understand why this is happening, we need to start with the fundamental impact of Brexit on the UK financial sector. Prior to leaving the European Union, London was undisputedly Europe's financial capital, benefiting from the single market, passporting rights, and deep economic integration with European investors. But the referendum result shattered that stability, triggering immediate uncertainty, and the outflows began. Since 2016, the UK has experienced wave after wave of investor withdrawals, reflecting the gradual realization that Brexit has not delivered the promised economic benefits. Instead, it has created barriers, introduced risk, and eroded Britain's appeal as an investment destination. The data speaks for itself. According to Morningstar, £16 billion was withdrawn from UK equity funds in the last year alone. And that number is down from the record £29.9 billion in 23, but the overall trend remains deeply troubling. Since the Brexit vote, a total of £97.4 billion has been pulled from UK-focused funds, raising serious concerns about the sustainability of Britain's equity markets. Investors have consistently favored other markets, particularly the US, which has delivered far higher returns over the past decade. The S&P 500 has outperformed the FTSE 100 dramatically, with US markets growing over 80% in the last 5 years, compared to just 17% for the FTSE. And this stark disparity highlights how capital has flowed away from Britain and into more stable, higher-yielding markets. The root of the problem is multifaceted. While Brexit is a primary driver, other factors have contributed to the UK's struggles, including weak economic growth, lack of government strategy, and uncompetitive tax policies. UK institutional investors have cut their allocation to domestic companies to record lows, reducing demand for UK-listed stocks. A failure to attract IPOs has only compounded the issue, leaving London Stock Exchange struggling to remain relevant compared to its European and US counterparts. Without significant inflows, the ability of UK businesses to raise capital is severely compromised, further weakening economic prospects. Tax policy is another self-inflicted wound. The UK's tax structure has discouraged domestic investment while failing to incentivize international capital. The lack of tax incentives for investing in UK equities, coupled with a share trading tax that makes Britain uncompetitive, has deterred both domestic and overseas investors. And meanwhile, other financial hubs have adapted, introducing policies designed to attract capital, making Britain even less appealing in comparison. What makes this situation even more alarming is that efforts to reverse the trend have so far been ineffective. Despite major overhauls of the UK listing regime intended to revitalize the market, the outflows have persisted. Recent attempts to boost investment have failed to inspire confidence, as investors see little in the way of structural economic reform or growth-driven policies. Regulatory uncertainty remains a significant issue, particularly in financial services, where Brexit has stripped the UK of its previous access and influence within European markets. And one of the most significant shifts has been the loss of passporting rights. Before Brexit, UK financial firms could operate across the EU with ease, using London as a gateway to European markets. Now, that access has been restricted, forcing firms to relocate parts of their operations to EU cities like Paris, Frankfurt, and Amsterdam. And this has led to an exodus of financial sector jobs and a decline in the influence of the UK's financial industry on the global stage. But it's not just financial services feeling the impact. UK businesses, particularly those in manufacturing and trade, have struggled with post-Brexit bureaucracy. Companies face costly delays, but also improved paperwork and reduced competitiveness compared to their European counterparts. A particularly striking example comes from the poultry industry, where firms have lost entire lorry loads of produce at the border due to minor errors in documentation. And this unnecessary friction in trade has discouraged investment and driven businesses to look for alternatives outside the UK. And the consequences of Brexit extend beyond the immediate financial markets. And there are still transitional periods running, not to forget that. The economic instability it has created has also influenced sentiment among everyday investors and pension funds. With economic growth stagnating and inflationary pressures squeezing household finances, fewer people are willing to invest in the UK market. And meanwhile, international investors see Britain as a less attractive destination due to its sluggish economy, the volatile currency, and inconsistent trade policies. But what can be done to reverse this trend? The government's current approach has been focused on regulatory tweaks and investor incentives, and the governments before that, but these measures have proven insufficient. What is needed is a fundamental shift in economic policy, one that restores investor confidence in the UK. And this would require addressing Brexit-related trade barriers, improving market access, and creating a more attractive tax environment for investment. Alignment with EU standards on goods and services could provide a boost, making UK businesses more competitive and reducing the friction that has hampered growth. And more broadly, closer cooperation with the EU could help repair Britain's financial reputation a bit. The possibility of deeper economic integration, even without full EU membership, could provide some stability to UK markets and encourage investment back into the country. The reality is that Britain cannot afford to remain an isolated financial hub. Without action, the outflow of capital will continue, and London's status as a financial powerhouse will further erode. At the heart of this issue is trust. Investors, businesses, and the financial sector need to believe in the UK's economic prospects. But right now, the uncertainty and instability caused by Brexit have made confidence in Britain hard to come by. Until there is a clear and credible plan to restore economic growth and financial competitiveness, capital will continue to flow elsewhere. And the numbers don't lie. The almost £100 billion withdrawn from UK equity funds since Brexit is not just a statistic. It's a sign of a country losing its economic footing. It's a wake-up call that should not be ignored. The UK faces a choice: continue down this path of decline or take decisive action to restore confidence, to attract investment, and to regain its place as a leading global financial center. And the time to act is now. So thank you for watching Outside Views, and if you found this analysis insightful, don't forget to like, share and subscribe for more deep dives into UK politics. And let us know in the comments what you think about the UK's economic outlook and what steps you believe should be taken to address these challenges. See you next time, and the next video is already right here in the end screen.